and welcome to Bloomberg Quint. The top headlines of this hour. Indian markets trade lower as investors take cue from global peers. And Glenmark is down nearly 3% after the US FDA makes 7 observations in its Baddi plant. And Bharat 22 exchange-traded fund trends higher after listing at 36.3 on the Bombay Stock Exchange. And Ivanka Trump arrives in Hyderabad to participate in the Global Entrepreneurship Scheme being hosted in India for the first time ever. Those are the top headlines. I'm Agam Akil. Up next is Hot Money with Darshan Mehta.
Thank you, Agam. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show. Senthil Manikandan of Newberry Capital, independent market expert Dharmesh Kant, and Vinit Bolinjkar of Ventura. They join us on the show. Vinit is running a little late due to traffic, but we'll start with our two other guests. Today on Hot Money, we'll discuss stocks like MindTree, PC Jewellers, Redington, Future Retail and Dalmia Bharat. Straight on to the first stock, and that is MindTree. A couple of brokerage reports which indicate a positive outlook have come up. It's down in today's trade, but yesterday the counter was up almost 6%. The stock is up almost 15% in November. Remember, a lot of brokerages have sell recommendation. So out of the entire scheme of events, 14 have a sell and only 7 have a buy on the counter. So what should one do with MindTree? Is the tide turning? Is valuation in favor of MindTree? We'll ask our guest. Dharmesh, what's your view on MindTree? Do you think that tide is turning for MindTree?
Yeah, definitely yes. Post the management commentary on the outlook of the business, so even the brokerages started turning positive on MindTree. What went wrong with MindTree was the acquisition of Bluefin and Magnet 360. So both those acquisitions, when they acquired, it was 6-7% EBITDA positive company. Post acquisition, what happened? The top line went down. At the same time, it became a minus 18% EBITDA negative company. So that dragged the entire margins of MindTree. Before that, they were consistently doing well, both in digitization space as well as the software space, and the traction was around 18 to 17% on a rupee basis, and that was the valuation which they were getting a multiple of 18-20 times. So it was always a premium valuation for MindTree. But now the management indicates that things have started turning, and this both this acquisition will turn EBITDA positive by next quarter or so. So that has triggered the entire valuation metrics back into play. If that happens, that will lead to 150 points of EBITDA accretion in the margins front. And that will translate to around 20-22% kind of a EPS CAGR for next 3 years.
Okay.
So that's a positive. I think valuation wise it's almost fairly valued at current juncture. But yes, if the numbers start trickling in, then there's a lot of scope for re-rating, and if that happens, to my sense, 720, 750 can be the likely target price based on FY20 earnings estimate at 17 to 18x of.
Yeah, but it's still trading at a higher valuation that even an Infosys does, or some of the large cap. So my question is such a valuation justified for a stock which has underperformed and for a company which is not performing to its par?
The stock has underperformed off late. For last couple of years, there has been underperformance. But if you look at the historical performance of MindTree, it has always been an outperformer at a premium valuation to Infosys and TCS initially.
Yeah.
So, but
is it justified now?
Yeah, definitely. Because if the numbers are going to come back, Infosys you don't see a double-digit growth coming into play.
Okay.
It's a single-digit 8 to 9% kind of a growth at best, which you can expect. This is a company which is going to give you around 18 to 20% kind of a growth in EPS.
Okay.
So, and then ROEs are fine. So, a growth trajectory which is double than that of Infosys or TCS. So, the valuations will be there. So, that is my take.
Senthil, do you agree? Do you believe that such valuations are justified for MindTree, and what the management has said in terms of turnaround? Is it possible? Do the numbers say that can actually happen?
If you see the acquisition the MindTree has done, the Bluefin and the Magneto, actually in the since 2015 both has been in the EBITDA loss, and even in the first half of this year, if you see the combined put together, they have revenue has been downtrend of around 17%. So I clearly think that the acquisition strategy is not going well for the company so far. But the management has sounded positive in the Q2 conference. But secondly, we have to look at the overall IT picture of the Indian companies. Couple of years back, the entire IT pack of Indian companies are trading at a premium to Accenture. But currently Accenture is trading at a premium to Indian companies because the technologies and the SMAC and the digital thing, and then IoT and blockchain, these are technologies that is going to be the future, and where the Indian IT companies are lagging. If you see Accenture has secured like 20 plus of small companies which are into this niche next future technologies. But whereas the Indian companies are morely focused on the in-house technology development, which is not factoring in and bringing the growth to the companies. So I'm neutral on the entire IT pack and also neutral on the MindTree.
Okay, so entire IT pack, be it large cap or small cap, you don't see any kind of bullish stance that is coming into this space.
So couple of niche mid-cap IT companies like Persistent or Take Solutions. So they are into like Persistent, they are into product development. They are not into this labor arbitrage play. So Take Solutions, if you see, they are into the life sciences segment. So these kind of niche plays we are bullish on.
Okay, so that's the view that's coming in from our guest as far as MindTree is concerned. Dharmesh is rather bullish on MindTree at this point of time, but Senthil does not share the same view. He is neutral on the entire IT space at this point of time, given the fact that growth is not coming in. But select pockets like a persistent system or a Take Solution is something that would excite him. Vinit will come in a while and we'll take his view also on that. But before that, we'll move on to the next stock, and that is PC Jewelers. The counter is trading at record highs. It's trading up almost 1%. Lifetime high. A couple of days ago, a positive note, brokerage note came out from Motilal Oswal. But among the brokerage community, it's a consensus buy among the entire space, because what we've seen like Titan also, there seems to be significant amount of traction that's coming in on the entire jewelry space. Senthil, I'll start with you. Any view on PC Jewelers? Will this traction continue?
Yes, so we are bullish on the company.
Okay.
Basically, if you look at the jewelry market in India, 70% is unorganized, and even in the remaining 30% organized, around 23% with the regional jewelry chains.
Okay.
So the pan-India players like Titan and PC Jewelers, their market share is just 7%.
Okay.
So with all these government regulations coming in, there is a high amount of complaint cost on these unorganized players. So this is favorable for the organized segment.
Okay.
And if you see the PC Jewelers history, since the IPO, they have opened around 50 plus stores.
Okay.
Currently, their store count is around 85 plus, and they are majorly in the north and central part of the India. And the company is also futurely targeting on the franchisee-based model.
Okay.
So going forward, this will be like return accretive and also the asset-light model.
Okay.
So we are positive on this company.
No. My view is that you spoke about going in from the unorganized to the organized market, but that happened when the GST was implemented, and there have been significant amount of time since that has happened. Don't you think that's already factored in the price for PC Jewelers? It's trading at record highs, no doubt.
Yes, so if you look at the growth, what the company has put up in the last 5 years, it's in the 25% CAGR. And with these, there is a huge leeway for growth for these organized players.
Okay.
Just 7%, and you look at the market size, it's like 2 lakh crore.
Okay.
Out of that, 1.4 lakh crore with the unorganized.
Okay.
So there is a huge leeway for growth, and I think the current market price, it is trading at around 20x, like rightly pointed out, it is trading at highs. But looking at the long-term perspective, 3 to 4 years, with the franchisee model kicking in,
Okay.
I think the stock can give 20-25% CAGR.
Okay. Do you agree, Dharmesh? It's a compounding multi-bagger story in the making, PC Jewelers? It's already moved up, but
yeah. See, I think from couple of years perspective, this is likely to be there. The compounding of jewelry segment will be there, and the reasons are I will tell you. See, the talk about shifting from unorganized to organized, I don't think that is valid, because the entire segment will become organized.
Yes.
You don't have a choice.
Yeah, that's what I was telling. Yeah.
You don't have a choice. So this entire 2 lakh crores of market will become organized. So now what happens is, who is going to eat into whose market share?
Yes.
So earlier it was the tax point, which was a differentiating factor. Now that has gone away.
Okay.
It will be the making charges of the jewelry, which will create a distinction between the market share gain and the type of designs you come out. So the designs again can be copied very easily. Overnight it can be copied. But the quality of the design and the trust part. So two factors will be a distinguishing factor. One is the trust which you have on the brand, and second is the making charges, which is lower. So on that count, PC Jewelers historically have a low making charge compared to that of Titan.
Okay.
So there they have an edge. valuation perspective is very cheap compared to Titan.
Yes.
Almost half the valuation it is trading at. And 20-22% compounding growth for next couple of years will be there because the unorganized players, the so-called unorganized, so they will take time to, come into the same level playing field.
Okay.
So that time is an advantage. So that is the reason why I think for current levels, you can still invest into PC Jewelers, and for a couple of years you will get a 50-60% kind of a stock price return.
Okay, so it's both our guests do believe that PC Jewelers is a buy. Welcome to the show, Vinit. I think traffic situation is holding you up, but that won't stop you from talking about PC Jewelers. So it's a double thumbs up. What's your view on PC Jewelers?
So I'd like to digress a bit. Is that if you look at the banking stocks, HDFC was at a very premium valuation to the other private banks. So you talk about Yes Bank, IndusInd Bank, and dearth of quality stocks led to all the valuations catching up.
Okay.
So as Dharmesh pointed out that the pie is there for everyone, all the organized players. So what I feel is Titan's valuation at 42 times FY20 and PC Jewelers at 25 times FY20. I think this valuation gap, which is a 50% discount, there would be a very sharp catch up in my opinion. So as you find Titan getting very expensive, you're left with less options.
Okay.
So PC Jewelers will kick in, and all these players will up their game.
Okay.
So while Geetanjali at 5 times looks to be the cheapest, but if it can get its act up and running, it looks difficult for them. Then you have Thangamal and you have TBZ. I think TBZ is up for sale, so there would be a kind of a game of takeover kind of play out there. And Thangamal is also going, but it's a very regional player.
Yes.
So when you talk of two large players, you have Titan and PC Jewelers, so there the catch-up will take place.
Okay.
So that is my opinion.
Okay, and we missed your view on MindTree, if you can share that.
So I think if you want to be in the IT space, I think MindTree is a better bet. Okay, they've got the digital pie growing from 39 to 42. It'll keep growing ahead. There are two acquisitions which they did, Magnet 360 and Bluefin. They've seen negative EBITDA margins post takeover, but I think if they come back up again, then this is a play to watch out for. And their client acquisition has been pretty robust. So new business coming in has been pretty robust. So at 14 times FY20 versus 17 times TCS, I think I'd rather play a MindTree.
Okay, so that's the view that's coming in. Just some flashes coming out in terms of what TRAI has indicated, if I can just read it off. TRAI releases recommendation on net neutrality. I really doubt any of the telecom stocks will probably react to this, but it's just some news that needs to be spoken about. Yeah, hardly any reaction that will come in any of the telecom stocks. Let's move on into the next stock, and that is Redington. The counter has been growing significantly. A couple of brokerages have turned rather bullish on the entire space. Let's ask, and if you look at what the recommendation is, it's a consensus buy, because 9 out of the 10 have given a buy recommendation and there is just one sell. Return ratios in between 5 to 13 times. So what's the view for Redington? Is there more space for it to grow? IDFC was the one that came out with the initiating report with the target price of 239. I'll start with you, Dharmesh. Any view on Redington?
Yeah, it's a positive bullish view. It's a 15-17% kind of a compounding growth story for next couple of years, and that is what the company has been doing on the top line front. Just due to some margin squeeze was there in the last couple of years, so that on the PAT front the growth was not there. But I think going forward with the type of reach they have and the foray into the African countries and Middle East countries, are paying rich dividend. That is where the attraction is coming from, and all the brands are there. So be it computer hardware or even the smartphones, Apple is they are the biggest vendor of Apple in India. So it's just a steady state kind of a play. Where it's a good service provider, they have already got the market traction going on, and 15-17% kind of a compounding, even the stock price will come as the earnings grow, and the levels, valuation is fairly valued and it will continue to
so the margin squeeze is definitely there. Is that not a concern? I think they work on very wafer thin margins. So is that a company that will can that type of a company be a big compounder? That's what my question is.
The calculation of margin, how you are looking at, what they are doing is say if a computer cost 1 lakh and they are selling at say 1.1, so that they are booking as a top line as 1.1 and raw material cost as 1. Actually, it is 10,000 the service charge because they are distributors.
Okay.
So as a distribution house, if you look at the margin, then EBITDA will the actual EBITDA will come at 40%.
Okay.
And PAT will go to 25 to 23%. But if you are comparing the way as a distributor, so they are not the product buyers. They are basically a distributors of the company. So there you are seeing 2%, 2.5% PAT and 5-6% kind of EBITDA margin. Okay. So it's a way of looking at things. But I do think that this will go. It won't change significantly. You won't see it's doubling or things like that because they are into an industry where it's a service sector oriented primary industry is there. So there you won't get better margins. It will more be a volume growth.
Okay, volume.
And that will come from Africa and Middle East countries.
Okay, Senthil, do you agree with what Dharmesh is saying, or you have a contrarian view on Redington?
We have a contrarian view. Particularly, we are not bullish on the business model per se. If you look at the business model of the company, it serves a supply chain for 200 plus brands. And if you look at top 5 brands, accounts for nearly 60% of their revenue. It's like Apple is more than 25%, and then Dell and Lenovo. So if you look at the companies, they are all in the technology space. And what you have seen is, if you see 3 years back, Xiaomi launched their phone in India. Currently, their market share is equal to that of Samsung.
Yes.
So in the past decade, the baton of mobility has transferred from Nokia to Samsung and Samsung to Chinese players. And the company is serving these technology players. So it's like a highly volatile and changing field.
Okay.
And even if the company doesn't, company takes the entire inventory risk on its books. So inventory risk is there, and then there is a concentration, client concentration risk is there. So these are the risks I find in the company, and the valuations also I find not comfortable.
Okay, you want to respond to that, the concerns that he spoke about with the coming in of significant amount of Chinese intrusion that's coming in. Would that not be a risk for a player like?
I don't think so, because see, whenever a new player comes, so they will be a distributor of that new players as well, which they have been doing. So between Samsung and Apple and Xiaomi, the market share may change. But for Redington, as far as the sales are there, whichever brand sells, they are selling it. So that margin will come to them.
So if you see Xiaomi, they have went for a city-based dealer system. They have just jumped Redington and they come for a city-based dealer. So Redington is not in the picture for Xiaomi. So there is no moat in the business model per se.
Okay.
And the company has to get into the next player who is going to target the market. So I think this technology space and the thing is highly volatile, and the company is morely concentration of risk is very high.
Okay, you believe that the risk reward is not in favor of this. Vinit, you don't track Redington, but any view on the sector as such?
So I think Redington is a very good play as such, and I believe that logo additions is a matter of fact. So although Xiaomi has come in, it's more on the handset side. They have Lenovo, which is one of the largest computer brands. So I think new logo addition, new product launches that happen will come through them because they have a very efficient distribution network. And they also have a subsidiary for logistics, which I think is a play on value unlocking.
Okay, so probably there could be value unlocking in Redington is what Vinit is saying. So 2 positive views coming in on Redington and one a slightly skeptical negative view that's coming in. Before we move on, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, the next stock that we'll talk about is Future Retail, the big 3.0 strategy that Kishore Biyani pointed out. He's targeting to become a $1 trillion company by 2047. So that's a very, very long-term view that they've given, and acquire new customers by opening almost 10,000 stores by 2020. So big talk that has happened with Future Retail. In a highly competitive market, is this something that will happen? And make no, the counter is absolutely expensive. If you're looking at it, almost 43 times this year's earning and 30 times next year earning. What should one do with Future Retail? Are the plans that they've given something that they can achieve? Vinit, I'll start with you. Is it just a plan, or can this actually be implemented?
No, if you look at the track record of Kishore Biyani, he has a track record of building extremely powerful brands. Execution has been one of his hallmarks. And again, it's purely the unorganized to organized play. He's in that value fashion retail, which is below $1,000 category. So that is where he can really grow. Also, what they have done is they've listened to the street, taken cognizance, and done a lot of restructuring. So they've cut down on heavy debt. They've cut down on, made their business asset light. They've lowered debt. That thing is going through, and I think there will be a 1,000 crore EBITDA company in FY20.
Okay.
And if you, as I give you the example of PC and Titan, so similarly here Avenue and FRL are like a similar example. So you have Avenue at 45 plus times FY20, and this guy is trading at 25 times FY20. So if this looks expensive and you got growth at 25 multiple, you'd rather play a value retail story, which is
no, but it's again coming at growth versus valuation, and for quality people always pay value. So,
but in my opinion, DMart or Avenue retail is very, very expensive.
Okay.
Yeah.
But you do believe that future retail, whatever they have said, they will be able to achieve. It's a very long shot target, 2047. So you are not even. So people don't even give 2020 guidance.
So I am not looking at 2047. I am looking at I'm just talking about the next 3 years.
Okay.
See, what is happening is 2 years back the market was discounting 1 year forward. Now in the bull market we are discounting 2 year forward. And if you want to have value and have a reasonable period of expectation, I think we have now rolled into 2 year forward rolling multiple. So September 20 is what we are looking at. And given that kind, I think there could be some upside for this stock.
Okay, what about you, Dharmesh? Do you believe that what Mr. Biyani is saying would be possible? Is it fairly valued? What's your view on it?
It's a very long horizon, so possibility, difficult to say about that. But going by the track record of Mr. Biyani, he has delivered most of the time. And the best part about future retail is they are open to changes. So brick and mortar business they did lay down, but now e-commerce is also they have been taking up aggressively. They are not relying only on brick and mortar.
Okay.
Having said that, valuation is very expensive. You cannot expect businesses like Future Retail or Avenue Supermarts to grow more than 20-25%.
Okay.
So that's the capping. That's a natural logical cap which is there on the growth factor. So any valuation above 40-45 doesn't look doesn't justify my mind. So I won't be buying into that just from the valuation perspective.
Okay,
business will do well, promoters will make money, but
What about you, Senthil? Valuation or growth? What will you choose for Future Retail?
So you're bullish on the business. The opportunity size it is offering, but if you look at the past 1 year, the returns have been like 4x it has given, and the business model of Future Retail can't be compared to the Avenue, because the Avenue Supermarket there is like a asset, FRL is like asset light business model, while Avenue owns its stores. So normally if you look at the retail business, you have to look at majorly 3 parameters. One is the same store sales growth. Last 4 quarters FRL has been clocking around 15% kind of CAGR. While look at Avenue, it's been clocking CAGR of around 20 plus on the sales growth front. And second point is the inventory turnover, because if you look at the retail business, it's highly cost competitiveness, and the high amount of turnover you do, the margins are pretty much very thin margins. So Avenue is clocking an inventory turnover of around 15x, but you look at Future Retail, it is inventory turnover just around 3-4 times. So if you look at the parameter wise, Avenue scores big. That's why I think the premium valuations have been offered to Avenue Supermarkets versus FRL. So I would like the business wise, I'm positive there is a large amount of growth, because the company is planning to put up 10,000 ECD retail outlets, and they are targeting 2,000 members per retail outlet. So 2 crore members they are targeting, and the technology they are partnership with Google and Facebook.
Okay.
So these are positives, but on the Return wise, I'm not positive.
Okay, so that's the view that's coming in on future retail at this point of time. Vinit is extremely bullish compared to Avenue. He's comparing and he's saying valuations are fine. The other two guests, they do indicate that the business is good, but valuation is not on the side of future retail. And finally, a stock of the day, the last stock of the day, that is Dalmia Bharat. It's actually doubled in the past 1 year. Is there room for the counter to grow significantly? It's trading at much higher valuations than its peers in the cement space. But what makes Dalmia Bharat tick? We'll ask our guest. Senthil, I'll start with you. Dalmia Bharat.
You're bullish on the company. If you see 10 years back, the company's market share was just 1%. Now they are the 4th largest cement manufacturer in India. And they have a capacity of 25 million tons plus. And if you look at the premium cement sales, it's around 10%. Company is targeting to get it up to 30% kind of sales on the premium category. And if you look at the company's deleveraging trend, company has been generating free cash flow and has been consistently reducing its debt. And the company's operational parameters, if you look, they are the best in the industry. They have the highest EBITDA per ton. And because of this, their raw material cost, high blending mix, plus their lesser lead time. So these are the things going positive for the company. Valuations also
Dharmesh, we're running out of time, but very quickly, what's your view on the Dalmia Bharat?
It's a positive view, though valuation now looks, catching up very fast. The stock price is catching up very fast with the valuation. But overall, 50% exposure in the South India and balance 50% in East and Northeast augurs well for the Dalmia Bharat. OCL is the key trigger out there. So that turnaround and the synergies are playing well. Though 70% raw material is through petcoke. So that will be a concern as far as input prices are concerned. But looking at the overall macro picture, demand pick, I think it's a good stock to be invested in.
Okay, 2 thumbs up, Vinit. Finally, your final view on Dalmia Bharat.
I agree with them on the credentials, but I think there is very little gap between the biggies and Dalmia now. So we are looking at 15 times EBITDA, it would be around 3,600. The stock might get a slight premium to these counters because it has got the best operating metrics and its presence in East, which is growing very strong, and South they have 3 plants, but Belgaum, which is close to Maharashtra, and Andhra and Telangana, which is doing well. So they should overall do well. But again, compared to these stories, I still am quite positive on Sanghi Industries, which I've spoken to about. So while there is space for a few 10 to 20% upside, I think I'm not that positive now. So I will be looking to book profits.
Okay, so that's the view that's coming in on the final stock. 2 extremely bullish views that are coming in on Dalmia Bharat. Vinit too is bullish, but probably a 20% upside, but he prefers the Sanghi Industries more than that. Before we wrap up on the show, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, Vinit, Dharmesh and Senthil, thank you so much for joining us on the show. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.
Are we live?